come on to the shares you own, the monthly income, the total income you're having, the total that you need through that particular time. We were talking about how could we make money to pay off some taxes that we owed, how much you still need to gain through the time, and how we're going to figure that out. You can use those numbers. If the numbers work, you can figure those numbers to figure out what you can pay and how you can pay. In this particular case, it's a monthly stock paying monthly dividend. These are the realized gains and so forth. And like I was talking before, you have the different ones here for the 2 years, the realized or gains and loss. Then you work on the different ones like the ORGN, how long you kept that, how long when you bought it, what the cost was, and just figuring that out in terms of what it would be to keep it or what you can do to make it a better thing. This is comparison and contrasting to working for your wage and the minimum wages and so forth, and just some different ideas about the contrast between ownership of stock versus working for the money that you have. Don't get me wrong, it's still work to understand this, but it's more of a mental and understanding work than it is physically going out and doing something. And once you have that experience and understanding, there are potentially times when you can make a lot of money in a very short period of time. Of course, it comes with understanding and knowing what your desires and goals are and so forth, and knowing the ins and outs of the market. Not that you're always going to make money, but you can also limit your losses as well. Here's just some tickers that we've had that we were considering and so forth. Some of the better ones that were available at the time. Like this has been 2 years ago that we tried for this. The shares that we bought, the different types of tickers, how much we were investing and so forth, like $1,000 there. Different MTR, BPT, tells what it is up there, the Royalty Trust, the Prudhoe Bay Royalty Trust, and so forth, some of the trusts we were looking at. You talk about which ones were best and why it was, the quarterly dividends, what we were looking at, how much we had invested, how much we actually had spent, and so forth. How many shares you buy. You figure out the numbers and you say, okay, does this work for me? Is this what I want? And then you look at the fundamentals of the company. You say, okay, as of 2006, they had 85 million barrels reserved. 2012, they might have 75 million, which they did. In 6 years, they've lost 9.5 million barrels. So at that rate, you can kind of figure, okay, 47 years, and at that rate, they're going to use it all. So it's going to continue to go down at some point, but realistically, most people's lifetime, it's not going to go too far. That's what you want to look for, something that's stable and making money and so forth. And of course, in this particular case, we're seeing here BPT or British Petroleum Prudhoe Bay, which is in Alaska. They already had it for 25 years. It could be from July 14th to 2061 at the current rate. In other words, they have it for another 45 years and no problem. So those are some of the things you want to look at, fundamental and technical understanding of that, because they both feed each other, particularly on a good and stable company or a well-known company. Again, these are just some of the list of the things we've been invested in, involved in, and so forth. Some of the different stocks we looked into, and some of the different pricing and what have you. What you really want to do is go back through these over time and see what your actual results are, and see what you've actually done and any investments that you've made. Sort of like we did with the other one where we had the whole list of things. That kind of tells, okay, how much money we make, how much we lose, why did we lose it. You can analyze that and go through it. And then you can say, okay, between November 2012 and July 2014, you made $258 in dividend income from your $1,000 investment. And then of course you figure, okay, you say $5,000, it's 200, your $1,000 investment up there is $268, that's 5% or so. You want to try somewhere around at least 10 to 20%. 10, 12% is good. 20% is what most professional investors try for, and it is possible to get a 20% return. Not necessarily just with dividends, but with dividends and options and the different things you can do to make money from a stock. You can generally get between 10 and 20% return on your money. Not consistently necessarily, but generally speaking, yes. And again, you need to see the profits and losses, and that's just the idea that you have the numbers and understanding how much you lost. Go through your trading journal and see how much you've got, how much you've lost, why you made money, sometimes understanding the reasoning behind why you lost so much money. Oh, I see why I lost so much. I was trading so often, or I was picking the wrong ones or getting out of it. I was too emotional in my trading. Okay, well, in that case, we'll look at a more solid company. We'll just set it and forget it. Well, this, well, that, whatever your options there are. These are some of the different ones that are good solid companies as of that time, like Edison and Caterpillar, some of those types of things. Some well-known that were making good dividends at the time, had good share volume and so forth. If you invest $1,000, how much could you buy? What's your years to get back your money invested? In this case, you're saying, okay, Edison takes about 22 years, 23 years to get your money back at their current years or current income over the years. You're talking 22, 23 years to get that investment that you've made back from their quarterly dividends, your yearly dividends. So if you make $43 a year, you've been paying it for 44. So if you started back when they first started, you might have your money back in return once or twice over. And then again, you have some of these other like 16 and 15 years, and that's what you generally want to think about: is how long is it going to take? What's my time horizon? And obviously, the more years, the more stable in some ways. For example, the ones that pay out the best, like Johnson & Johnson, for example, and so forth, they're going to be 2-3%, which means several years. Whereas these other ones, for example, these ones here, Sandridge Trust, the trusts and things, are going to be higher returns, but are they also able to keep that return for that long period of time, 20, 30 years, 40 years, 100 years, whatever it is? How long have they actually been paying that return? How long can they afford to pay that much? If you're paying out 20% of your income to somebody, then how long can you afford to do that? I'm not saying it's necessarily impossible. It's just make sure you understand why and how they're able to do it. And with some of the trusts,